Recognizing inflation. Inflation is defined as the general rise in prices in an economy over a given time period. The Federal Reserve usually aims for a low and stable inflation rate of around 2%, which can indicate a growing economy. However, economic shocks can cause inflation to rise into the double digits. Inflation has fluctuated throughout history. Prices rose 10% to 15% in some years during the 1970s and 1980s. Inflation has since moderated. Inflation rates in the 2000s ranged between 2% and 5%, while inflation in the 2010s was between 0% and 2%. In other words, compared to other periods in history, prices have been remarkably stable in recent years. Inflation, on the other hand, has recently returned to the discussion. Inflation was 5.4% in the 12 months ending in July 2021, one of the highest rates in many years. Inflation can be classified into three types. Demand pull inflation occurs when demand exceeds available production capacity. In other words, there is more demand for goods than the current supply can meet. Prices rise as a result. Cost push inflation occurs when production costs make it more expensive for businesses to produce the same goods. As a result of the increased cost of inputs, market prices rise. Built-in inflation occurs when workers demand higher wages to offset rising living costs. This type of inflation can result in a feedback effect in which businesses must constantly raise prices to keep up with the rising cost of labor. Why take inflation into account? Inflation has a number of unsettling effects, the most obvious of which is that it erodes your purchasing power over time. As inflation sets in, a dollar will buy fewer goods and services than it did previously. Because interest rates have been unusually low over the last decade, long-term investors and retirees alike have become less concerned about the threat of inflation. In the future, the threat of inflation must be recognized as a real risk to a comfortable retirement if not properly accounted for. Inflation increases economic uncertainty. Inflationary pressures tempt the Federal Reserve Board, which is expected to raise interest rates in response. The Fed's actions can cause stock market volatility in the short run, and rising interest rates can cause bond funds to lose value. Inflation is a chance. One of the most effective ways to combat inflation is to maintain a well-diversified and fully invested portfolio. In the long run, money invested in stocks tends to outpace inflation, whereas positions in real estate, commodities, tips, or I-bonds can only provide additional diversification. Cash on the sidelines will always lose value, while long-term bonds will suffer if interest rates begin to rise. In general, inflationary periods, whether temporary or permanent, provide an opportunity to review your financial situation and make adjustments for what lies ahead. If you are concerned about rising inflation, follow Buffett's advice and invest in productive assets, such as high-quality businesses with low capital requirements rather than low-yielding bonds that don't increase payments in tandem with inflation rates.